Welcome to today's video. We're unpacking a subtle but costly pitfall: selling vested company stock to fund your IRA without a tax-aware strategy. We'll show you how timing your sale affects your adjusted gross income and IRA eligibility, and how choosing the right tax lots can preserve more cash for your retirement goal. Along the way, you'll see practical workflows, clear diagrams, and decision frameworks you can apply before you click sell. By the end, you will have a concise checklist to navigate AGI thresholds, Roth eligibility, and the long-term versus short-term capital gains split. Now that you know what's ahead, let's outline today's agenda and then set a quick disclaimer to keep us grounded. Here is our plan. First, we'll frame why this decision matters. Next, we'll walk through the timing issue and AGI. Then we'll dive into selecting the right shares and a practical workflow for using specific identification at your broker. After that, we'll compare tax treatments and eligibility, and finish with 2 quick quizzes and a summary playbook. With that roadmap set, let's begin with a brief but important disclaimer. This video is for educational purposes only. Everyone's tax situation is unique. Thresholds change over time, and different filing statuses can have different outcomes. Always verify numbers for the current tax year and consult a qualified tax professional or financial planner before acting. With that in place, let's set the big picture so the strategy makes intuitive sense. At first glance, selling vested RSUs to fund your IRA looks straightforward: convert shares to cash and contribute. But 2 interlocking issues can break the plan. First, the timing of your sale determines which year your capital gains hit your AGI, and higher AGI can reduce or eliminate Roth IRA eligibility and the deductibility of traditional IRA contributions. Second, not all shares are equal for tax purposes. Long-term holdings generally enjoy lower tax rates than short-term holdings, and you can further refine the outcome by using specific identification and targeting lots with higher cost basis to minimize realized gains. With the concept in focus, let's explore why timing is often the most controversial and impactful lever. Realizing capital gains increases AGI, which is why timing becomes controversial. If your projected AGI is close to phase-out ranges for Roth contributions or traditional IRA deductibility, shifting the sale by just a few weeks, say, from late December to early January, can determine which year captures the gains. To make this practical, run a 2-year projection that includes base salary, expected bonus, other investment income, deductions, and the estimated gains from selling your shares. Then compare AGI and marginal tax brackets for each year. The goal is to place the gain in the year where it does the least damage to eligibility and your marginal rate. Now that we understand the timing lever, let's visualize a decision flow that ties eligibility and deductions together with your sale date. Begin by projecting income for both candidate years. First, test Roth eligibility. If eligible, consider placing the sale in that year to keep the door open. If not eligible, test whether a traditional IRA deduction is available. If it is, selling in that year may still be tax efficient due to the deduction. If neither option is favorable, evaluate whether you can shift the sale to the other year, or reduce the gain by selling fewer shares, or selecting higher basis lots. After confirming the best year and bracket, execute the order using specific identification so the realized gain aligns with your plan. With the flow set, the next step is selecting which shares to sell to minimize immediate tax. To minimize tax drag while raising cash, first look for lots that have been held more than 1 year, so the gains qualify for long-term rates. Then use specific identification at your brokerage to explicitly choose those long-term lots with the highest cost basis, which reduces the taxable gain realized per dollar of cash raised. Keep detailed records, trade confirmations, and screenshots showing the selected lot identifiers. If you skip specific identification and default to FIFO or average cost, you may realize larger gains than necessary, effectively paying tax on phantom profits. With the principle in place, let's walk through a practical, step-by-step workflow for using specific identification correctly. Begin by verifying that your broker allows specific identification for your shares. Pull the detailed tax lot report and sort by holding period and cost basis. Focus on long-term lots first, then target the highest basis among them. Determine the cash you need to fund your IRA, and estimate the share count at today's price, allowing for slippage. When you place the order, explicitly select specific identification and choose the exact lot IDs you planned. After the trade fills, archive confirmations and screenshots showing the selected lots. Finally, update your AGI projection with the realized gains to ensure your plan still meets eligibility and bracket targets. With the workflow clear, let's compare tax treatments to understand why this approach matters. Long-term capital gains are generally taxed at preferential rates that are frequently lower than ordinary income rates, while short-term gains are taxed at your marginal ordinary rate. The holding period threshold is 1 year, so simply crossing that horizon can materially lower the tax cost on a given dollar of gain. By intentionally selecting long-term, high-basis lots, you can both reduce the gain realized and shift more of the gain into the long-term category. This is why specific identification pairs so well with timing strategies. Next, let's contrast how high AGI interacts with Roth and traditional IRA options. On the Roth side, direct contributions can phase out as AGI rises, so if you are near the phase-out range, pushing the sale into the other tax year may preserve eligibility. On the traditional side, deductibility depends on AGI and whether you or your spouse are covered by a workplace plan. If deductible, the contribution can offset part of the gain's impact. If the traditional contribution is not deductible, you may be better off shifting the sale, reducing gains through lot selection, or considering other planning tools. Having contrasted the account types, let's list practical AGI levers you can evaluate. Here are practical levers to evaluate. First, shifting a sale from December to January moves the gain between tax years, which can protect eligibility. Second, selecting higher basis long-term lots reduces the taxable gain realized. Third, adjusting the sale size lets you target only the cash necessary for your IRA, minimizing excess gains. Finally, coordinate sale timing with bonuses or option exercises to avoid stacking income in the same year. With tactics in hand, let's lock in understanding with 2 quick quizzes. Question 1. You need $6,500 to fund your IRA, and you have 2 lots. Lot A was held for 18 months and has a high cost basis. Lot B was held for 8 months and has a low cost basis. Which lot is typically better to sell first to minimize current taxes? Option 1, Lot A. Option 2, Lot B. Option 3, sell both equally. Option 4, it makes no difference. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is Lot A, the long-term, high-cost basis lot. This choice generally realizes a smaller gain per dollar of proceeds and qualifies for long-term capital gains rates, which are typically lower than ordinary income rates applied to short-term gains. Selling the low-basis, short-term lot would likely create a larger taxable gain at higher rates. Next, let's check your grasp of timing and AGI. Question 2. True or false? Realizing a capital gain increases adjusted gross income, which can impact your Roth eligibility in that same tax year. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is true. Realized capital gains increase adjusted gross income. If your AGI crosses certain thresholds, you may phase out of Roth eligibility or lose the deductibility of traditional IRA contributions. With that confirmed, let's consolidate the main takeaways into a quick playbook. Here is your playbook. First, project adjusted gross income for 2 years and place the gains in the year where eligibility and brackets are most favorable. Second, sell long-term, high-basis lots using specific identification to minimize gains. Third, document everything for your records. Fourth, coordinate sale timing with other income events to avoid stacking. Finally, recheck your thresholds and projections each year because rules and personal income can change. To close, let's summarize the core message and your next steps. In summary, the timing of your sale determines which year the gains hit your AGI and can protect or jeopardize IRA benefits. Pair that with specific identification to choose long-term, high-basis lots, and you reduce tax drag while still funding your retirement. Always confirm outcomes with records and a brief post-trade AGI check, and consult a qualified tax professional to validate your plan. To finish, I have a quick request to help this content reach more people. Thank you for watching. If this helped, please like the video, share it with someone planning a sale, and subscribe for more practical, research-driven guidance. I would love to hear your questions and strategies in the comments, so join the conversation and let us learn together. See you in the next one.